I'm Dave Whitmore. Thanks for joining us for this short video about options, and in particular, the Greeks, understanding the Greeks. We're going to start with some math. The reason for that is because the source of the Greeks comes from what's called an option pricing model. And here's an example. This is from what's called the Black-Scholes option pricing model. And it is from, again, as I said, this is where the Greeks are derived. Now, the pricing model in this particular version of it gives us the theoretical value of a call option. Now, we're not going to do the math here, have no fear. But we can make some observations of the notation that is here, and that will help us sort of understand the relationships of these things called the Greeks. So first of all, for example, you'll see S and K in here. So S represents the price of the stock. K represents the strike price of an option. And so this has to do with the intrinsic value of an option. So that's one of the major parts of the value of a call option is the intrinsic value. You'll also see T. That's time to expiration. Here we see sigma. Yes, it's a Greek letter. It's not one of the Greeks, but it represents the standard deviation of the historical fluctuation of the stock's price. And then you'll see R here in a couple of places, and that is because interest rates do have a role in the value of an option. Okay, so these factors all contribute to what gives a value an option its worth. Once we have a market price of an option, though, we can turn it around and derive values related to these, and that's where we get the Greeks. So let's meet them. Delta, gamma, theta, vega, and rho. What the Greeks tell us is how we can expect an option price to change if something else changes. So, for example, a very simple one to understand is the delta. The delta tells us how much an option is expected to change if the stock moves $1 up or down. Gamma tells us about delta because delta changes too. So gamma tells us how much delta will change if and when that $1 move occurs in the stock. Okay, so delta and gamma tell us how the price of the option responds to the price of the stock. Theta tells us something different. Theta tells us about time. So theta tells us how much an option's value will change when time changes by 1 unit, in this case, 1 day. Now, recognize that time never expands. So theta goes in one direction, and that has important implications for option strategies. Vega tells us how an option will react to changes in volatility. And then finally, rho tells us the relationship of an option price to changing interest rates. Let's take a look at some option data, and we'll go through and look through each of them. And we're going to be starting with delta. But we do want to point out that once you are here, you have a wide range of choices of columns that you can use. In our example here, I've selected and displayed the 5 Greeks in my chain, and we'll go through them one at a time. And I mentioned you can go up into the menu up there and choose from a wide range of available columns. All right, so number 1 is delta. I like to call it the versatile Greek because it can be used in several different ways. And I want to sort of look at 2 of those ways here. So first, let's go through the numbers. We're going to focus on this particular option. It's a 38 strike. The stock is right at around 38. So we're looking at an at-the-money option. And you can see here that delta is 0.5202. And so the direct interpretation of that is that if the stock rises $1 with a delta of 0.5202, that option should rise or fall $52. It's about a $215 option. Look at the bid and ask there. We generally use the midpoint to think about what the value is. That would be $216. So from $216, it would be $52 higher. So that's the dollar movement in the option. One of the applications of delta is to use it as an estimate of probability. And the interpretation from a probability standpoint is that the delta tells us the probability that that option will be in the money at expiration. So with the delta of 0.8299, this particular strike, the 34 strike here, which is in the money. Remember, the stock's $38. That's a delta of 0.8299. That means there's an 82.99% chance, probability, that that option will be in the money at expiration. I think we'll agree to call that 83%. But what does that really mean? Well, recognize that being in the money doesn't necessarily mean that that trade is profitable or that it even has very much value, because an option that's just 1 penny above the strike price would be in the money and its value would be 1 penny. The point there is that the proper way to look at the probability equation here is from the other side, and to then realize that, well, what that says is that there's a 17% chance of a worthless expiration. So relatively deep in the money call option in this case has a relatively low likelihood of a worthless expiration. And when I say relatively, I mean relative to the rest of the scale of the options that we have on our chart here. So with a 66 delta, that implies a 34% chance of a worthless expiration. And the probabilities get more onerous as we go up. So lesson number 1 regarding probability: where you decide to select your strike price is going to affect the risk of your trade. And if you want to somewhat lower the risk of worthless expiration, you migrate toward higher price in the money options. And as you move into out of the money options, recognize that you are taking on greater risk because of the higher probability of a worthless expiration. So that's point number 1 about delta as probability. The second way to use delta is to see the leverage that it offers us. So we've already established that delta tells us how much an option is expected to move if the stock moves $1. But let's look at it on a little bit of a different way. So here we've got our same options ranging from the 34 strike to the 42 strike with the respective deltas there. And I'm putting my option prices here not in the way the premium would be quoted, but multiplying it times the 100 in the contract to just put it into the total dollar terms. That's, you would pay $552 to buy that 34 strike. And so we'll do the same thing to delta. We'll multiply it times 100. And now what we could see is if the stock moves $1, we get $83 of price movement for a $552 asset. And that is a swing of plus or minus 15%. So this tells us, again, how much leverage is contained in dollar terms in that delta. And if we fill in the rest, we see that the relationship here is that the leverage gets higher as we move into the higher and higher strikes. And eventually we see that the out of the money call, the very inexpensive $77 one, has a relatively high percentage swing. You know, put it in dollar terms. If you bought this for $77 and that subsequent trading, the rest of the trading day, the stock was up $1, you would see a $25 swing in the value, a gain of a third. Similarly, if the stock fell, you would lose a third. Leverage that's available through delta. So 2 ways to look at delta. Delta as probability and delta as leverage. Let's go back to our chain. And before we leave delta, we'll talk about gamma to simply, again, point out that what gamma tells us is that delta changes as well. We must know this if we look at the delta column as we did before. The deltas are high in the deep in the monies, and they're extremely low in the way out of the monies. So as the stock price changes, those deltas must change so that they can become higher if they go in the money. And so we know delta must change, and gamma tells us by how much. The main point with gamma, as you can see here, is to recognize the range that delta can have. And so if it rose $1, delta would rise up to almost 0.6. And if the stock fell $1, delta would fall below 0.45. Now on to theta. Is time on your side? That's the story that theta lets us listen to. So here are our figures for this. Theta in this case says that if 1 day passes, the value of this option will fall by $1.78. And it's a $200 and something option. And so our first reaction might be, well, big deal. But the important part of the lesson is that that's the theta right now, but theta changes too. And so let's see that. We talked about our option pricing model earlier, and I use an option pricing model to calculate the theoretical value of an option. The option is specifically at the money strike. The assumption is it's a $50 stock, a $50 strike price. There's a volatility and interest rate assumption there, and we don't need to discuss that. It's not part of the conversation right here. And what I'm showing you is, if you look at the first bar here, it says that if that option has 125 days to go to expiration, its value would be $425 or $425, as I've put it on the chart here. Now, the exercise I want to go through is to look at 10-day periods to see the effect of 10 days of time in different windows here. So here's what I mean. If I do the same calculation with 115 days to go to expiration, the value of the option is down to $405, 4% less for those 10 days. This 10-day period is 6% lower theoretical value. Here it's 8%, here it's 16%, and here it's 42%. So this demonstrates the acceleration in time decay that occurs, and that it gets particularly onerous in the last month or 25 days of an option's life. This has implications for trading strategy decisions. One simple rule of thumb is that option buyers are better off holding an option and trading out of it long before the rapid time decay occurs, whereas option sellers like to sell shorter term options and benefit from that rapid time decay. Those are things that, as you explore option strategies, the Greeks can help you in your strategy decision making. So one relationship with theta is that it is highest in at the money options. So let's compare it to delta, though, and see an interesting relationship that crops up. So first off, here's 3 option prices. We're just looking at 3 of them here with our deltas. And here's theta. Now, as I said, notice that the 38 strike has a theta of 0.178. It's 0.151 for the 34, and it's 0.136 for the 42, lower on each of those, higher in absolute terms on the 38. But if you divide that by the delta, what you'll see is that the impact of theta is actually stronger on the out of the money option. It's got more of a negative impact on the value of that option, and particularly on its delta. So that further sort of fleshes out the trade-offs that you make when you think about the deltas and the time decay in your option decisions. So let's summarize that. Moneyness is what we mean when we talk about an option being in the money, at the money, out the money. Of course, at the money is always a little bit figurative, because not often a stock is precisely at a strike price. So it's at the money is thought of as being the closest. When we look at the leverage in an option, we see that the in the monies, while still presenting leverage, make no mistake about it, it's lower relative to either at the money or out of the money. And the out of the money options have the highest leverage. As far as probability goes, well, the probability of loss is lower in the money. We've demonstrated that, and higher out of the money. And the impact of time, it's least on in the money options and highest on out of the money options. So here presents the decision table that you have. Do you want to seek higher leverage, higher action trades? Well, recognize that you're accepting higher risk of loss and that the impact of time will be greater on that trade. If those kinds of trades are, you've tried that and they've become less attractive, recognize what moving to at the monies and in the money options can do to different sorts of outcomes in your option trades. So I want to talk about volatility. And to start with, I just want to talk about this idea of the market price of an option. An option has a market price, and it basically has two components: the intrinsic value and the time value, or what is sometimes called the extrinsic value. The intrinsic value is simple. It's just the stock price versus the strike price. In the case of a call option, if the stock is above the strike, there's intrinsic value. Time values the rest of the option price. And so that comes from days to expiration, volatility of the stock, interest rates, and dividends. So this market price is determined by buying and selling in the open market. But there is this idea of the theoretical price as well. So let's move into volatility generally, and then we'll talk a little bit about Vega. So volatility is both an input and an output to a pricing model. So stocks will have their own historical record of volatility, and the analysts can take that data, input it into a pricing model, and come up with a theoretical value for an option. And that's the sort of first step in value in those pricing models. We can then sort of reverse engineer that and say, okay, if I have the option market price, I can input that into the pricing model, and an output that I can get from that is what we call implied volatility. You can imagine stocks with different historical volatilities here. I'm stylistically representing three $50 stocks, all of which took different paths to get to that price over the three months that we've shown here. So that's historical volatility. But implied volatility is calculated by looking at the prices of options, and it is interpreted as reflecting the degree of future volatility that option traders expect. So option traders have this sense of the volatility of a stock leading up to now, and that sparks their sense of what the option prices should be, and from that we calculate implied volatility. I picked out three stocks that can be used as representative of differing implied volatilities and how that translates into option prices: Big Telecom, Cruise Line, and EV Meme Co. Here are the implied volatilities of those stocks, and here are the stock prices. Now, my exercise here was to go to an at-the-money call option and then determine how much time value is in it and take a look at that compared to the stock price. And so here's my first calculation. Big Telecom, 51.14. I had to use the 50 strike in the money by $1.14. The options market price was $1.88, so therefore there's 74 cents of time value, and that represents about 1.5% of the value of the stock. So the value of options for this stock, relatively small as a percentage of the value of the stock. What about Cruise Line? $75 stock, so I had a $75 strike I could use. That option was $6.80. I subtract the time value of 75, in the money value of 75 cents, and I get 605. That's 8% of the $75 stock price. And then for EV Meme Co., we have a $20 stock. The $20 strike is $3.25. That's in the money by 37 cents. Therefore, there's $2.88 of time value, or 14%. So again, high implied volatilities leads to high option prices, and whether that's cart before the horse or not, they're hand in hand. So back to our option chain, and here's Vega. To put it into dollar terms, our Vega of 0.0630 means that if implied volatility rose by 1%, the option value would rise or fall by $6.30 if the volatility rose or fall. One important note to recognize here is that a 1% move is actually rather small in changes in implied volatility. You could see much more meaningful moves. So volatility is a major factor in changing option prices. Well, let's finish with Rho. Rho is the relationship with interest rates. It's fairly straightforward. We can illustrate it by using an option pricing model like we did before on time value. Let's take a look at the outcomes for different rates. So I used an option pricing model. The chart here on the left is an assumption of 28 days to expiration. And you can see at various interest rate assumptions what the theoretical value of that call option would be. Not a huge difference in, interest rates moving from 1 to 1.5 to 2%. Even all the way to 10% doesn't greatly change the value of that option. Longer dated options, it's more of a factor. Simply using a period of 210 days, you can see the added time there as well. Our goal here has been to understand the Greeks, to translate them, to speak about them in English. But the real goal is then to recognize how those Greeks impact option prices and what that means for strategy decisions, risk management, price targets, exit strategies, etc. Thanks for listening to our video. Hope you've enjoyed this as part of your option education. I'm Dave Whitmore. We'll talk to you next time around. Thank you.